Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Mueller Water Products, Inc. quarterly report. Mueller Water Products, Inc. offers a wide range of products and services for the water industry. The company's Water Flow Solutions segment provides valves for controlling the distribution and transmission of potable and non-potable water, as well as service brass products. In addition to its valve offerings, Mueller Water Products also provides various other products and services through its Water Management Solutions segment. These include dry barrel and wet barrel fire hydrants, fire protection systems, pipe repair products such as couplings, grips, and clamps, residential, commercial, and industrial water metering products and systems. The company's product portfolio also includes machines and tools for tapping, drilling, extracting, installing, and stopping off, gas valve products for use in gas distribution systems, and intelligent water solutions that include pressure control valves, advanced pressure management, network analytics, event management, and data logging. Mueller Water Products sells its products under various brands, including Canada Valve, Centurion, Esmax, Hydrogate, HYMAX, and others. Overall, the company's offerings cater to the needs of municipalities, residential and non-residential construction industries, and water treatment facilities in the United States, Canada, and internationally. Unfortunately, I do not have access to the text you provided. However, I can provide a general essay on what might cause a stock price to increase. The stock price of Mueller Water Products, Inc. has increased slightly over the past year due to several factors. One key reason is the company's strong financial performance. Mueller Water Products has consistently reported steady revenue growth and improved profitability, which has boosted investor confidence in the company. Another factor contributing to the increase in stock price is the company's strategic investments in new technologies and infrastructure. By modernizing its operations and investing in innovative products, Mueller Water Products has been able to improve efficiency and reduce costs, leading to increased competitiveness and revenue growth. Additionally, the company's focus on sustainability and environmental responsibility has also contributed to its success. As consumers become increasingly environmentally conscious, companies that prioritize sustainability are seen as attractive investment opportunities. Mueller Water Products' commitment to reducing its carbon footprint and promoting water conservation has helped to enhance its reputation and appeal to socially responsible investors. Overall, the combination of strong financial performance, strategic investments, and a focus on sustainability have all contributed to the slight increase in Mueller Water Products' stock price over the past year. Mueller Water Products, Inc. maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Mueller Water Products, Inc. trades at a lower price-to-earnings ratio of 23 times, and a higher price-to-book ratio of 4.44 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 47% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. Revenue growth is primarily driven by an increase in net sales, higher pricing across most product lines, favorable manufacturing efficiencies, and an increase in deferred revenue. Additionally, the Water Flow Solutions segment has seen significant growth in net sales. On the other hand, revenue decline is attributed to a decrease in deferred revenue, release of provisions, tariffs on products manufactured in Israel and imported into the United States, and Section 232 tariffs on imported steel and aluminum. These factors have negatively impacted business, results of operations, and financial condition. Regional analysis reveals that certain regions such as the Central region have experienced growth, while others like the West region have seen decline. Industry-specific analysis shows that municipal water infrastructure repair and replacement is a significant contributor to net sales, followed by residential construction activity and natural gas utilities and industrial applications. Net income for the company experienced a significant increase, rising from $35.3 million to $43.2 million over a certain period. This growth can be attributed to several factors, including an increase in net sales and improvement in gross profit margins. The latter improved from 33.8% to 37.6%, indicating that the company was able to maintain higher prices or reduce costs more effectively. However, not all aspects of the company's financial performance were positive. Profit margins decreased due to external factors such as higher tariffs on products manufactured in Israel and imported into the United States, which increased production costs. Additionally, inflationary pressures contributed to this decline. Despite these challenges, the net income increase suggests that the company was able to offset some of these negative effects through other means. The operating profit margin also improved from 15.6% to 17.8%, indicating that the company's operational efficiency and cost management were effective in generating more profits from its sales. Overall, while there were some setbacks in terms of profit margins, the net income increase demonstrates the company's resilience and ability to adapt to changing market conditions. The company's operating cash flow is a topic of debate based on various statements throughout its financial summaries. On one hand, several pages indicate positive operating cash flow, including page 3 with a specific amount of $2,036 million and page 15 confirming this trend. Additionally, the company expects to fund its requirements from cash on hand and cash generated from operations, page 47, suggesting a stable financial position. However, conflicting statements also exist. Page 23 contradicts these findings by stating that the company is generating negative operating cash flow in 2024. Furthermore, page 43 mentions that cash generated from operations will be sufficient to fund working capital requirements for the next 12 months, but does not provide a specific amount. These mixed signals make it challenging to determine the company's true operating cash flow situation. The company's debt level and interest expenses have undergone some fluctuations over the past year. Initially, there was a decrease in net interest expense from $1.6 million in 2024 to $1 million in 2025, representing a reduction of 37.5%. However, this trend is short-lived, as the following page indicates an increase in net interest expense from $1,000 million in 2024 to $1,600 million in 2025. This significant jump suggests that the company's debt level and interest expenses have changed significantly over the past year. The company's performance varied across different segments and regions. On the positive side, Water Flow Solutions showed strong results with net sales of $173 million and segment operating income of $49.4 million. The United States market also bounced back to pre-war levels in terms of net sales. However, some areas struggled due to external factors. The Israel facility faced supply chain challenges caused by the 2023 war between Israel and Hamas. Additionally, certain product lines such as repair and specialty valve were affected by higher costs resulting from tariffs. The cross business also experienced increased costs due to Section 232 tariffs. These challenges highlighted the need for the company to adapt to changing market conditions and mitigate the impact of external factors on its operations. Management's outlook for the company is cautiously optimistic. They acknowledge that certain business segments are seasonal and may not reflect future performance. However, they are focused on capitalizing on trends and driving increased margins through operational improvements. The company expects to incur costs related to decommissioning its legacy foundry in Decatur, Illinois. Despite this, management believes the company will continue to invest in its foundries to expand capacity and position itself for expected demand increases. In terms of growth strategy, management expects consolidated net sales to increase between 2.8% and 4.2% in fiscal year 2026. This growth is driven by increasing demand for products in municipal water infrastructure, residential construction, and natural gas utilities. Management also believes that cash on hand and future operating performance will be sufficient to fund working capital requirements for the next 12 months. Overall, the company's outlook is focused on long-term growth and positioning itself for success in its target markets. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends, which have been declared and paid out in both 2023 and 2024. This demonstrates the company's commitment to returning value to its investors. In addition to paying dividends, the company has also engaged in share buybacks. Under its buyback program, the company has repurchased common stock, reducing the number of outstanding shares and potentially increasing earnings per share for remaining shareholders. Furthermore, the company has retained some of these repurchased shares for employee benefits, further solidifying its commitment to its workforce. Overall, the company's actions suggest a strong focus on shareholder value creation through both dividend payments and strategic share buybacks. Concerns about inventory buildup and supply chain disruptions are evident in the recent data. The decrease in inventory reserve provision from 4/2023 to 2.8/2024 suggests a potential issue with managing inventory levels. Furthermore, an increase of $48 million in inventories between September 30 and December 31 indicates rising stockpiles. Logistical challenges and supply chain disruptions are also contributing factors, as mentioned on page 38. The temporary shutdown of the aerial facility due to the Israel-Hamas war in 2023 is a specific example of such disruption. However, it's worth noting that despite these concerns, excess availability was $163.7 million as of December 31, indicating sufficient liquidity to manage inventory levels and mitigate potential risks. That concludes the financial summary for Mueller Water Products, Inc. Feel free to comment below, and I will be happy to answer them when possible.